Hello, everyone. Welcome to the market opening bell for Wednesday, October 22nd, your 10-minute guide to the stock market. The market is optimistic about the end of the US government shutdown, boosting Hong Kong stocks. The Hang Seng Index opened 301 points higher and later surged by up to 508 points, reaching a high of 26,367 points. However, gains narrowed by the close, with the index up 168 points or 0.7%, closing at 26,027 points. The Asia index rose 69 points or 0.8% to 9,302 points, while the Hang Seng Tech Index gained 74 points or 1.3% to 6,007 points. Total market turnover was 2,646.57 billion Hong Kong dollars. Southbound funds saw a net inflow of $1.171 billion into Hong Kong stocks, with notable net purchases including Mart at $1.121 billion, Xiaomi $481 million, Hua Hong Semiconductor $441 million, China Mobile $177 million, and SMIC $128 million, ending 8 consecutive days of net selling. Net sales included Tracker Fund at $1.102 billion and Alibaba at $429 million. Statistics show Southbound funds have net sold Alibaba for 3 consecutive days, totaling $4.336 billion. Technically, the Hang Seng Index finally filled the downside gap from October 13 and briefly broke above the 20-day moving average at 26,331 points, but failed to hold. The next test is whether it can stabilize above 26,000 points. If 26,000 is lost, the next support level is the 50-day moving average at 25,910 points. China's A-share indexes opened higher and maintained gains. The Shanghai Composite Index rose above 3,900, closing at 3,916 points, up 52 points or 1.4%. The Shenzhen Component Index closed at 13,077 points, up 264 points or 2.1%. And the Chinex Index closed at 3,083 points, up 90 points or 3%. Total turnover in Shanghai and Shenzhen markets reached 1.8779 trillion yuan. The renminbi's US dollar central parity rate was raised by 43 points to 7.093. In tech stocks, it's reported that Alibaba's Huawei has launched its C plan for AI business related to conversational AI applications. With its first new product expected to launch soon, Alibaba's stock rose 2%. In earnings news, China Telecom reported operating revenue of 394.3 billion yuan for the first 3 quarters, up 0.6% year-on-year, with service revenue at 366.3 billion yuan and net profits at 30.773 billion yuan, up 5% or 34 cents per share. EBITDA grew 4.2% to 115.6 billion yuan. For Q3 alone, operating revenue was 124.8 billion yuan, down 0.9%, with net profit attributable to shareholders at 7.756 billion yuan, up 3.6% or 8 cents per share. Mart reported Q3 overall revenue growth of 245% to 250% compared to Q3 2024, with China revenue up 185% to 190% and overseas revenue up 365% to 370%. Offline channels grew 130% to 135%, while online channels surged 300% to 305%. Overseas regional performance included Asia Pacific, up 170% to 175%, Americas up 1,265% to 1,270%, and Europe and others up 735% to 740%. Lookbook Group announced that for the second quarter, July 1st to September 30, overall retail value revenue, and same-store sales outperformed Q1, rising 18%, 15%, and 10% respectively. Same-store sales in Hong Kong, Macau, and overseas markets grew 10%, 15%, and 13% respectively, while mainland China saw 3% growth. In Hong Kong, Macau, and overseas markets, same-store sales of gold products turned from a decline to a 6% increase, while fixed-price jewelry sales surged 27%, with fixed-price gold products up 68%. The average selling price of gold products in Hong Kong rose 27% from 12,600 Hong Kong dollars last year to $16,000, and in mainland China it increased 17% from 7,100 yuan to 8,300 yuan, driven by business improvements and a low base effect. Retail value and revenue in Hong Kong, Macau, and overseas markets saw double-digit growth of 13% year-on-year. The proportion of fixed-price jewelry retail value rose from 26% to 30%, with fixed-price gold products increasing to 19%. Today's debutant Fibercom Wireless, stock code 638, saw its great market trading on Phillip Mart yesterday, opened 16.3% higher at 25 Hong Kong dollars, with a high and low of $25 and $21, closing at $21.3, down 0.9% or 20 cents from its IPO price. Turnover was 1.99 million shares, valued at $42.8 million. Excluding fees, a 200-share lot would incur a paper loss of $40. U.S. President Trump's comment that a planned meeting with Chinese President Xi Jinping next week may not happen sparked uncertainty. U.S. stocks showed mixed performance, driven by better-than-expected earnings from traditional blue-chip stocks like Coca-Cola and 3M. The Dow Jones Industrial Average hit the record high of 47,125 points during trading, closing up 218 points or 0.5% at 46,924 points, a new closing high. The S&P 500 ended nearly flat, while the Nasdaq fell 36 points or 0.2% to 22,953 points. The Nasdaq Golden Dragon China Index, reflecting Chinese stocks, dropped 81 points or nearly 1% to 8,279 points. Alphabet fell 2.2% after rival OpenAI launched its first AI browser, ChatGPT Atlas. Broadcom dropped about 2% and Nvidia slid nearly 1%. Plant-based meat company Beyond Meat surged 146% after announcing sales in over 2,000 Walmart stores. Netflix reported Q3 results after Tuesday's close, with revenue up 17% to $11.51 billion, meeting expectations. Net profit rose 8% to $2.55 billion, or $5.87 per share, below the expected $6.97. The stock fell 7% in after-hours trading. The company attributed lower Q3 operating profit to an ongoing tax dispute in Brazil, but said it expects no significant future impact. Netflix forecast full-year revenue of $45.1 billion, up 16%, in line with prior guidance of 15% to 16% growth. It lowered its full-year operating margin forecast to 29% from 30% due to the Brazil tax issue. General Motors reported Q3 adjusted earnings per share of $2.8, beating expectations of $2.31. Revenue fell less than 1% to $48.59 billion, above estimates of $45.27 billion. Adjusted EBIT was $3.38 billion, exceeding expectations of $2.72 billion. GM raised its full-year guidance, expecting adjusted EBIT of $12 to $13 billion, up from $10 to $12.5 billion, and adjusted earnings per share of $9.75 to $10.5, up from $8.25 to $10. For Q4, GM expects adjusted earnings per share of 1.64 to $2.39, with the midpoint of $2.02, above the consensus of $1.94. GM also reduced its expected tariff impact for the year from 4 to 5 billion US dollars to 3.5 to 4.5 billion dollars, with about 35% of the impact offset. The stock rose 15.7%. 3M reported Q3 adjusted earnings per share of 2.19 US dollars, beating expectation of 2.08 dollars, with adjusted revenue of 6.32 billion dollars, slightly above estimates. The company raised its full-year profit guidance to 7.95 to 8.05 US dollars per share from 7.75 to $8, and expects an operating margin increase of 1.2 to 2 percentage points from 1.5 to 2 percentage points. The stock rose 7.7%. Coca-Cola reported Q3 net profit up 30% to 3.7 billion US dollars, with adjusted earnings per share of 82 cents, beating expectations of 78 cents. Adjusted revenue was 12.41 billion US dollars, slightly above estimates. Units case volume grew 1%, reversing the prior quarter's decline, though sales in Latin America and North America were flat. The company reaffirmed its full-year outlook, expecting 3% earnings per share growth and 5 to 6% organic revenue growth. For next year, Coca-Cola expects light revenue and profit fluctuations due to currency impacts. The stock rose 4.1%. Coal prices fell 6% to 4,082 US dollars on Tuesday, after hitting a high of 4,381 dollars on Monday, with the market viewing this as a delayed correction. Our stock pick today is COSCO Shipping Energy Transportation, stock code 1138. COSCO Shipping Energy Transportation focuses on two core businesses, oil tanker transportation and LNG transportation. It boasts the world's largest oil tanker fleet capacity, covering all mainstream oil tanker types, making it the most comprehensive oil tanker owner globally. As of June 30, 2025, the group owns and controls a fleet of 157 oil tankers with a total capacity of 23.448 million deadweight tons (DWT) and has 18 oil tankers under construction with a capacity of 2.961 million DWT. In terms of LNG transportation, as of June 30, 2025, the group has participated in the investment and construction of 87 LNG vessels, of which 52 vessels with a capacity of 8.763 million cubic meters are operational, and 35 vessels with a capacity of 6.285 million cubic meters are under construction. Additionally, there is one bareboat charter LNG vessel with a capacity of 174,000 cubic meters. All operational vessels are serving long-term charters, ensuring relatively stable revenue. As the LNG vessels under investment and construction progressively become operational, the group's LNG transportation business has entered a harvest period. As the oil tanker owner with the most comprehensive fleet types, the group utilizes its owned and controlled vessels to engage in various operations, including spot market chartering, time chartering, signing contracts of affreightment (COA) with cargo owners, and participating in pool operations. By leveraging synergies between international and domestic trade, large and small vessels, and crude and refined oil, the group maximizes its vessel type and route advantages. This enables it to provide end-to-end logistics solutions, including importing raw materials for international trade, domestic transshipment, refined oil transfer and export, and downstream chemical product transportation, helping clients reduce logistic costs and achieve mutually beneficial cooperation. The group recently completed an A-share issuance to specific investors, issuing 694,444,000 1,444 shares at 11.52 yuan per share, raising net profits of 7.979 billion yuan. The issuance involved 7 investors, including the indirect controlling shareholder, COSCO Shipping Group, National Green Development Fund, China Reform Holdings, China State-Owned Enterprises Structural Adjustment Fund, Cinder Securities, Hubei Railway Development Fund, and China State-Owned Enterprises. Mixed Ownership Reform Fund. The raised funds will be used to construct 6 VLCCs, 2 LNG carriers, and 3 Aframax crude oil tankers, expected to optimize the fleet structure and enhance the clean energy layout, securing the company's future fleet scale and market competitiveness. OPEC Plus has accelerated production increases since April this year, which is expected to drive crude oil refineries to drive crude oil prices downward, encourage refineries to replenish inventories, boost crude oil trade demand, and inject momentum into the oil tanker market. Additionally, after the US imposed port service fees on Chinese shipping companies and Chinese-built vessels, China retaliated by imposing special port fees on US-related vessels in accordance with regulations. Against this backdrop, Chinese shipping companies like COSCO Shipping Energy Transportation highlight see their greater strategic value. Recommendation buy at $9.90, target $10.80, stop loss at $9.40. I personally do not hold the above stock.